If you're like me, you're probably looking for a good way to store your capital where you can be in control of it, and maybe you're looking to pay off debt. I've been doing some research about the infinite banking concept and velocity banking, and I'm wondering which one's the best for this use. So velocity banking is a strategy used to pay down debts and liabilities, specifically mortgages. And what it's going to do is it's going to use the lazy cash that's sitting in the rafter of your house, commonly called equity. And that's what we're going to do. We're going to use a home equity line of credit, and we're going to use it as your banking system. Then what you're going to do is you're going to take your income and run it through the home equity line of credit while paying all your expenses using, in most cases, a 0% intro credit card, and then we use the remaining amount to get you ahead. So one of the perks of velocity banking is you're paying your mortgage off sooner. And in doing that, you're actually saving interest. And then you're also adding back some of the equity that you can then use to pay emergencies, or if something comes up, or even an opportunity that might strike you. The one thing you have to understand is the banks, when they structure mortgages, they structure it as velocity is against you. In other words, why is it that when you get a mortgage, the first 5 to 7 years, you're paying almost all interest back to the bank and hardly anything goes to principal? That's because the bank is winning in the velocity game. This strategy changes that game, puts velocity in your favor so that you're paying it off faster, and all that interest you would have given to the bank is now yours to use. The infinite banking concept is a process where we use a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. And the purpose of this is we direct some of the money we would normally save through this policy, and we build high cash value. That cash value can be used for a lot of things, and it also accomplishes uninterrupted compound interest on your money. The specially designed and engineered whole life has some really unique features, and one of them is the ability where we can put money into it, earn a guaranteed interest rate on that money, and then we have access to take that money out without interrupting the interest earned on that account. So both of these concepts use the term banking, because that's really what we're doing. We're applying the banking functions in our life using capital that we have or capital that we're going to use that's hidden in the rafters. And we're trying to disconnect from the traditional banking system where we give up control of our money to the banks. And in both of these strategies, we accomplish that. But let's take a look behind the scenes and see exactly how each of these are put together, and let's look at the pros and cons. So what's required to make these work? Well, first and foremost, for velocity banking, we got to have equity. And a lot of people right now do have equity in their home. It's a pretty known thing that home values have gone up, so that might not be a problem. The second thing we got to have is we got to have credit. In most cases, your credit score is going to have to be a 680 plus in order to really maximize your home equity line of credit. We got to find a credit card, and preferably one with a 0% intro rate, because this is where we're going to pay our expenses, and then we're going to use the home equity line of credit to pay off that credit card every month. So you got to be able to find one of these and qualify for one that meets your needs. You can't be living paycheck to paycheck. You got to at least have enough money to put it through this system where there's extra money every month. For example, if you make $4,000 a month and your expenses are $2,000, you have a positive cash flow of $2,000 a month. That would make this work. So let's break this down into steps on how you actually use the velocity banking concept. First, we need to open a home equity line of credit. What we're going to do is step 2, we're going to use that home equity line of credit to make a principal payment on your principal mortgage. All right, so now we're on step number 3. Step number 3, we want to deposit all of your take-home income right into the home equity line of credit. And then step number 4, we got to pay those monthly expenses. So we're going to use that 0% credit card to pay all your living expenses. Then step number 5, what we want to do one time per month, we want to use that home equity line of credit to pay down or pay off the credit card, preferably pay it off. Then what we want to also do is don't forget to make that normal monthly mortgage payment, because you can't not make your mortgage payments. And then the last step is step number 6, we want to pay down the home equity line of credit every single month. And when it reaches 0, which if you do this properly, you just begin the process all over again. So the infinite banking concept, you got to also do a couple things. So what's required to make this work? Well, first off, we got to have an insurable person. So because this is life insurance, specifically a specially designed and engineered whole life, we got to have a body to insure. The insurance company won't just give you a whole life policy without somebody to insure. So we got to have an insurable body. If you're not healthy, well, we got to find somebody that you can insure, and you can be the owner of their policy, which means you got to have an insurable interest. So that's number 1. Number two, well, we got to have disposable income to make your premium payments. Remember, these are specially designed and engineered. You want to be able to deposit as much as you can into these vehicles based on what you're currently saving today. And then number three, because these are specially designed and engineered whole life policies, you got to find somebody that actually knows how to build one that will work for the infinite banking concept. So you don't want to go to the insurance store and just find somebody that will sell you a whole life. You want to actually find somebody that knows how to do this, knows how to build these policies. Now, when you design one of these policies, whoever does it for you, you want to make sure that it's designed for cash value. And not just cash value, high cash value. Not death benefit. There's always going to be a death benefit, but the death benefit is going to be relatively low in comparison with how much cash value you're going to build. This is the opposite of how a whole life is normally built. Step number two, we want to open a segregated checking account. Nothing different than a regular checking account, but the only reason we want to do this is we want to use this for all of our banking use. So any money that goes through your banking system goes into this account and then back out. And the reason we do this is books and records. All right, step number three, what we're going to do is we're going to take a policy loan. It's going to be a loan against the death benefit. The loan comes from the insurance company, and they just advance you part of your death benefit while collateralizing that loan using the cash value you've built up. We're going to use that to pay off the debts. And this also is used in velocity banking. We want to start with the lowest balance. Not the highest balance, not the highest interest rate, the lowest balance, and then we want to go to the highest balance. Step number four, we're going to take the payments that we used to give away to those debts, the small debts we paid off, and we're going to recapture them through that segregated bank account that we set up, and we're going to put that money back into the policy as a loan repayment. You see, all we're doing is moving the money in a big circle. Let me show you. The money goes into the specially designed and engineered whole life. So these would be the premium deposits. Then what we're going to do is we're going to then take the loan from the policy using the cash value as collateral. And remember, the loan is just taking part of your death benefit. Then we're going to run that through that segregated bank account, and we're going to then pay off whatever debts we want. But if we paid off, let's just say a Visa, and you were giving Visa $100 a month, we want to recapture that $100 a month and move that money back through the segregated account. It's always going to stop there, and then pay off the loan balance. And in doing that, your money just continues to keep moving in a circle. But the one thing that didn't stop is the premiums you deposited in there never stopped earning interest and dividends, because the money you took out, the loan, wasn't your money leaving your account. The money you took out was the loan from the insurance company. All right, so step number five, what we want to now do is we want to make sure that we pay the interest to the insurance company, but this is only done one time per year. And we can do it using cash value, which I don't recommend, but some do, or we can just use it with leftover money that's in that segregated account. But we want to make sure we pay the interest on the policy loans every single year. Step number six, we want to repeat this until all your external debts, all your liabilities are completely paid off, and then all the money that you were paying to those external debtors is now ending up in your private bank. That is the infinite banking concept. So both of these concepts, the velocity banking concept and the infinite banking concept, are for the person really looking to get ahead, control their money, and then get back all the money that they're giving away to everybody else. The velocity banking relies heavily on a home equity line of credit. I will tell you that I love home equity lines of credit and using them to make that lazy money go to work. That's actually sometimes doing some damage because you're losing tax deductibility of the mortgage. You're losing other benefits that maybe you have from just paying that mortgage off over a longer period of time. So let's compare these two. The velocity banking, you're taking your money, your income, and you're putting it directly into the home equity line of credit, of which then you're making the payments to all those credit cards and paying them off each month. The amount that's left is essentially paying down the home equity line of credit or building the equity that you have to use the next time. In other words, if you had a $100,000 home equity line of credit and you paid it down to $95,000, then you've just made $5,000 that you can use. You're going to make premium deposits into that specially designed and engineered whole life. And when you make your premium deposits, the premium deposits are going to show back up as cash value as early as immediately. What I mean by immediately is the first 30 days. Now, I do want to talk a little bit about the drag on the infinite banking concept. When you make your premium deposits in the early years, you are going to give up access to some of that money. Typically in the designs, you're going to have access to 60 to 90% of those premium deposits in the first year. But every single year, you're going to have access to more as the compound interest starts building the plan up. So one of the pros of the velocity banking is you get to pay off your mortgage relatively quickly, and you also get to continue paying your monthly expenses. So the velocity is in your favor, even though it was designed for the bank to win in the velocity game. You're just reversing the roles. And I think the best part about the velocity banking is this one. You get to use that lazy money that's sitting on your couch, eating your potato chips, watching your TV while you're off working. You're making your money work for you. That money was just sitting in your house, in the rafters, and now you're tapping into that equity and using it to pay off debts. That's my favorite part. So let's hit some of the cons of the velocity banking. First off, it can be costly. Not if you do it right, but if something goes wrong, you can't find that 0% credit card. For some reason, you didn't pay the credit card off 1 month in anticipation of paying it off later. I've seen this go wrong many times, and it's not because the system and the concept doesn't work, it's because the person doesn't apply this the proper way. And when they do that, it becomes costly. It also can be complicated. There's a lot of moving parts, a lot of things changing. The interest rate on the home equity line of credit can go up. Very rarely does it go down. You also have to make sure that you're following the system and using this and putting all your money in, paying all your bills from that. So there's a lot of moving parts and a lot of things that can go wrong with that. We're not really earning a return here. We're just using the equity in our house. You see, the appreciation, which some people would think is the return, the appreciation of their house, that appreciation is separate from the home equity line of credit. The money in your home equity line is earning nothing. That equity, which is the equity in your house, is just sitting there being lazy. Although you have control and access to use it, there is a lack of control. If you remember 2008 and other recessionary periods, banks can freeze your line of credit. They can reduce your line of credit. If the value of your house depreciates or deflates, the bank can actually reduce the amount of your home equity line of credit, which could be risky because now all of a sudden your plan just went out the window. That's a real concern, and it's a concern that we can document that it's happened many times in the past. And most recently, in 2008 and 2009, this happened to everybody. It was a meltdown of the real estate world, and when that happened, banks just froze lines of credit. And that actually happened last year during COVID as well. So that's a big con. All right, so now let's talk a little bit about the pros and the cons of the infinite banking concept. It earns uninterrupted compound interest. Every dollar that you put through this specially designed and engineered whole life will always earn interest and dividends. And in doing that, your money is able to work for you even while you're using the money. That's the biggest pro. You can use this money tax-free, including all the money that it's made after years of compounding. The loans don't need to be repaid. This is confusing for people, and people really struggle with this. Remember, the loans are being made against your death benefit. So you're leveraging a death benefit, so therefore the loans during your lifetime don't have to be paid because the insurance company will just repay the loan upon your graduation. A nice way of saying when you die. The other thing that we didn't really cover is legacy. Now, for most of you, you have families, you have maybe children. The legacy that you create is done with the infinite banking concept because of a death benefit. No matter how much you use the money, you will always have a death benefit that's paid out to your beneficiaries of choice. So the legacy play here is paramount and not found in velocity banking. And my favorite part, control, control, control. You have access and control to that money without anyone having to say anything about it. You don't have to apply for it. You don't have to go to the bank and say, why did you lower my home equity line of credit? Your money is always available to you by a click of a mouse or a simple phone call, and you can get that money out anytime for any opportunity. So when we're really talking about control, that's a huge pro of the infinite banking concept. So what are the cons of the infinite banking concept in these privatized banking policies? Well, a couple. Number one, you got to qualify. They don't just give these things to everybody. You have to actually be healthy, or you have to have a body to insure. So there's an insurable interest that you got to find, or you just have to be healthy enough to get one of these policies and qualify for it. There's a cost for the cost of insurance. So whatever life insurance value that's on this, the death benefit, there is a cost for that, and there's a policy service fee, usually $50 to $100 per year. But again, when you really look at the numbers and how these work, cost is only an issue in the absence of value, and there is a lot of value provided. In the first few years, your policy will not be efficient. You're going to have access in the first year to 60 to 90% of the money that you deposit, like I mentioned earlier, and in the second year, it's still not going to be 100%. Now, although this might hinder some people from doing this, I have to ask, when you make deposits into your bank account, do you take all of that money right back out? because I don't, you're always going to leave money in there. So if you don't have access to all of your money, is it really that big of an issue? For me, it's not. You got to treat your money the same as you treat the bank's money, and you're okay paying the bank's interest. So when you borrow money from your policy, you are paying interest on those loans. There's ways to reduce this. We can use lines of credit, commonly called a cash value line of credit, which would bring that borrowing rate from roughly about 5% down to anywhere between 3 and 4%. But we still have to pay interest on this money. So a lot of people really want to always try to poke holes in that. Oh, why would I use my own money and pay interest on my money? The reason is, back over here, your money never left your account, and it's earning a guaranteed interest rate plus dividends. And in all the policies that we design, the guaranteed interest rate and dividend is more than the interest that we're paying on that loan. So how would you like to be able to use your money, all of it or a portion of it, and still get paid more than what it cost you to use that money? For me, I love that. It's called leverage. This is why the wealthy use this. So let's summarize all this. We covered a lot of ground. So which one of these two strategies is best for you? Well, if you're really trying to take back control of your money and you're trying to have that money accessible and usable while you're still earning interest on that money, it's very easy to see. The privatized banking and the infinite banking concept is probably going to be the best fit. But if your number one goal is just to pay off your mortgage, then maybe the velocity banking is your best choice. But really, when it comes down to it, what I'm trying to do is I'm trying to put myself in the best position today so that not just today I can get ahead, but also in the future I'm way further ahead and I didn't have to work any harder, any longer, or take on any additional risk for this. With the velocity banking, I love the strategy, but there's a lot of unknowns, a lot of things that will change that will affect what potentially could happen in the future. And that's not helping a legacy. I care a lot about my family and my little one. I want to make sure that I provide that legacy, and the infinite banking concept will make sure it does that while giving me control and access to that money. The next question I would ask is, can we combine the velocity banking concept with the infinite banking concept? The answer is yes. So let's go back to the beginning. In velocity banking, what we did is we used the equity in a house and we deposited all of our income into that home equity line. But what if we just changed one thing? After we had the home equity line, instead of doing this, what if we actually took that lump sum and we just, instead of paying off the mortgage, what if we just changed one thing and we put that money into your privatized banking policy, that specially designed and engineered whole life? What if we just changed that? Well, then we could earn that guaranteed interest and dividends on all of that money, and then we could take that money back out, run it through the segregated account, and we could do lots of things. Heck, if we wanted to pay the mortgage off, well, we could just take that money and pay the mortgage off. Then take the mortgage and then recycle it back over here. Or, if that didn't work, what else could we do? Well, we could pay off all the debts like I showed earlier. We could stack those debts from lowest to highest, and we could use the money from the policy to pay those off and then start recapturing that money that you used to give to your debts. Oh, but maybe your debts are all paid off. What else could I do? We could invest that money. We could find a deal like a loan to do, a private loan, and we could lend that money out at 12% or 10% as shown here. We could actually run it through a company and start getting additional tax deductions if you have a good CPA. It doesn't really matter how you look at this. It's endless possibilities. That's why it's called the infinite banking concept. And we're now just using money that's sitting lazy in the rafters of our house to fund the private banking policy and then doing everything exactly how it was being done before. So that's another thing to consider. We got a full video of that coming up soon. You can check it. It's time to take back control of your lazy cash.